Good morning, ladies and gentlemen. As always, we start with the fixed income complex in the United States, where, exactly as we said last week, absolutely nothing is going on. The 5-year note has been in a 7 basis points range. We have basically the lower bound around 180, while the top bound is just short of 190. We think this kind of consolidation continues until at least Friday when we have non-farm payrolls, and then we might see a bigger move. But the longer this we just hold above the 200-day moving average in yield and in price, as you can see on this chart, the greater the likelihood that at some stage we will break it and go and fill these gaps up towards the 119 area and down towards 170. We need some inflation to show up in the system, otherwise just the sheer weight of this price action above the 200-day moving average could provide a technical breakdown in the next few days ahead. The same thing is very evident in the 10-year note. We are basically just sitting on top of the 200-day moving average in a very, very tight range, which is unsustainable. Either very soon we make a move higher towards the 260 level, or we will break down and test these levels around 210. It's bound to happen sometime this week on non-farm payroll, we imagine. So nothing to be done until then, but we need to watch out for breaks lower in yield in the next few days. The European complex, and this is a weekly chart of the Schatz, the 2-year in Germany, is likewise stuck. We are basically trading around the middle of all the weekly Bollinger Bands. They are compressing, showing that for the next several weeks we will have only 2, 3, 4, 5 basis point ranges, which is the typical summer doldrum. We have no data out of these EU, and certainly nothing from the ECB for several months. The first thing we have to look forward to is actually Draghi speaking at Jackson Hole next month, and this will just languish until we get there. The 5-year note, we try to make these breaks higher in yields. We are failing them because there is nothing to sustain them. We are more likely, as we have said for several weeks, to come back and fill these levels around minus 25 than we are to make new highs in terms of yield, simply because there are no huge movers or reasons to move. This is the 160 level in around the 62 area in yield, 160 in bonds, which is so important. We don't have enough momentum, so we're more likely to go towards these levels, which is, in the 40s in yield, so around 163, 163 and a half, before we have enough possibility and momentum to try and break the 62 on the upside. Time is needed for the technical position to move back to neutral. Given that the fixed income complex is doing so little in both the United States and in Europe, it surprises us somewhat that the dollar is as weak as it is. We warned you about this 93.60 level in DX, the dollar complex. The market struggled with it all week, and then finally broke down on Friday through it. We said two weekly closes through it, and that is a signal to us that we are going to have some more trend extension, probably all the way down towards this level, which is just above 90. It is surprising because we are not moving out of any yield differential range that we have been in for the past several months, and therefore it would be logical that this is unsustainable and that we will go back and fill towards 95 in the dollar index. We have managed to turn the 200-day moving average, so from now on the the dollar is officially in a downtrend. Any kind of move back up towards 95 to 96.60 will provide a good opportunity for a sell. But we do think we need to revisit those levels at some stage before we embark on a big move down in the dollar complex. It's just too easy at the moment, and that can be seen, and the market is far too stretched, and that can be seen from the euro. Look how far away we are now from the moving averages. The moving average is a 108 for the 200, 113 for the 50-day. It is, we are very, very stretched. The RSIs are well into the 70s. It would make sense that somewhere around 117.50 to 118 we stop and we fill back down towards at least the 116, if not the 115, 114 area. That is what would make sense to us. But on the other hand, the market seems to be very bullsed up. We think prematurely, but it seems to be very bullsed up. So we will only play against it with options. We will not position outright against the euro, as the market really seems to have the bit between its teeth. The euro has weighed on the DAX. It has basically moved from the 13,000 level down to close the 12,000 level, and we are now going to test the 200-day moving average, which is rapidly coming up towards the 12,000 level. We're at 11,860. We still see a danger over the next few days of a rapid test towards 11,860, which will be our buying level. We think that that will be the culmination, the get me out of Europe trade, because people are very much overweight Europe. It will happen sometime before non-farm payroll, we think, and should coincide with a top in the euro index and a bottom in the dollar index. This is a chart, or a weekly chart of SPY FEU, so the European Stocks 50 in dollar terms. As you can see, for the past several weeks and indeed months, it's done absolutely nothing after breaking out from this channel. As we told you, it is now turning the 200-day moving average. So to us it signifies that any further dip in the DAX and the Stocks 50 caused by the euro is at some stage a major buy. We don't think we will make it through the 200-day moving average. We are far more likely to cascade lower towards these levels last seen in 2016. So we are still bullish on Europe far more than we are bullish for the States. We might be wrong, but we think that this will coincide with a high in the euro index, and that will allow the DAX to move back up towards the 12,500 to 13,000 level. As we are at the end of the month of July, it is interesting to have a look at the monthly chart for the equities. Here we have the SPY. It is still being supported every time it touches the 5 month moving average. It is huge support. This was at 2,410. It'll probably be at 2,420 or so next month, and the candle is anything but bearish. It is in fact still a bullish candle, indicating that the path of least resistance for the equities is still up, still risk on. This is now going hyperbolic. We would not be surprised in the slightest. In fact, we expect a test of the top of the Bollinger Band and even through it, well into the 2500s. The same can be seen in emerging markets. This is a weekly chart of EEM. You can see how it rested on this trend line. It has turned all the moving averages. It is now resting and waiting for a move. We would not be surprised to see 50 within a couple of months in EEM. We are now at 43, so that's another 15% move in EEM over the course of the next 2 or 3 months. Going down in time frame, and this market is doing technically absolutely nothing wrong. Every time there is a little dip, it is bought. We're not even at the middle of the Bollinger Bands, which are at 24.52 in cash. Every time there's a 10-point dip, it is bought very aggressively, while people get terribly overexcited about that dip. There is absolutely nothing wrong with this market action. We still think that any dip towards 24.50 is a buy for a move well into the 2500s. This market is probably going to go parabolic at some stage, simply because there are no sustained sellers. There are many buyers on any dip, and people get overexcited and get short at the lows, and then the next day the market just starts trending upwards again. We have seen it so many times, but so many times, and yet people insist on shorting it. And while with no justification whatsoever, it is certainly not breaking any of the technical levels it needs to break to turn bearish. For the market to turn bearish and for the selling to become sustained, XLP XLY needs to take out this channel that it's been in since 2016. And this channel basically is your risk on channel. The market is nowhere near doing that. The pullbacks in XLP XLY are so tiny that we are more likely to have a thrust lower. If we enlarge this, if we can, if the machine will let us, we shall see that all the moving averages are pointing well down. The spread between them is nicely wide. All this is just corrective action before we think there will be one last thrust down to all-time lows and an acceleration, a parabolic acceleration in the price of SPY to the upside. Once again, we emphasize that for the market to have anything but short-term dips, money has to start moving into other asset classes. This is SPY TLT. Is this a bearish chart? Absolutely not. 200-day moving average, 50-day moving average, price well above it. It looks like we're going to go and break the highs at some stage. So still risk on, very much indicated. It is more likely than not that in order to have a top, we need to have a price action like we did here back in 2011, whereby price just goes parabolic for a few days and then reverses, or we had here back in 2014. This is just too quiet. It is unlikely to break down before it has really tested the upside and made new highs. Here we have Jeff Gundlach's favorite indicator for bond yields, and that is gold over copper. So the more the price falls, the more copper is favored over gold. And we are now testing this trend line, which is funny how the spreads are always in line with the outright markets. You will remember from the beginning of the video that we are sitting on the 200-day moving average in terms of yields. Well, what Jeff Gundlach wants to happen is for this spread to break this trend line and start going down towards the 30 level, which should coincide with a big thrust upwards in terms of bond yields. Whether it will happen or not, we don't know. We think it's more likely to go back and test the moving average for over the next few days, which would indicate a period of bond yields coming off. But should that happen, and we're going to put a very important alert on this trend line, then we would agree with him. Any break of this trend line, which has been basically holding the market since 2012, is going to be a very important break and will indicate that yields are going up. It would be also significantly bullish for equities, simply because we think that it would indicate a period of resurgence in production and indicate that the spread between TLT and SPY is going to go basically ballistic on the upside. SPY over commodities is beginning to show signs of life to the downside, whereby commodities are being bought and favored over equities. We think that will be short-lived. It might come down a little bit towards 16, but this moving average should catch it and take it higher. It is interesting though to see that all the equity markets that we have been following and that we have put the alerts on many weeks ago are beginning to show the first signs of life to the upside. It is nothing huge, but they are beginning to show some reflation. Whether this is just the beginning of it all or whether it'll be sustained is yet to be seen. But that actually brings us to what possibly could be the best trade at the moment, or the one which has the least risk. And this is XLE, the energy sector within the S&Ps. We think that has finally turned. You will know that we're long from about here, 64. It becomes a very simple trade now. Any dip towards 65.20 is a big buy with a stop below 64.85. This level is going to be very important. So the first buy level should be around just below 66, with additions around 65.30, with a very clear stop below these levels. If we are reflating somewhat, this market could easily go to the 0.382 retracement of this whole move down, which is just above 69. So you're having, buying it here, you're having a clear 3 to 4 to 1 risk reward ratio, and this move should be relatively quick, 3 to 4 weeks, basically 1 month to reach 69 in XLE, or break down and continue to new lows. So 65, between 65.10 and 65.80, so that's a 1% buying range for a move up of at least 4%. I want to leave you with a few thoughts on volatility. This is a chart of the volatility in the Nasdaq. You will see that it bottomed in March of this year when the Nasdaq was a good 500 points lower, i.e. 10% lower than it is now. And it has been trending upwards while the Nasdaq has been going up in price. So don't let anybody tell you that volatility must go down if price goes up. It just simply isn't true. We have maintained for many months that the top in the stock market will not happen until volatility goes up with price. That is simply because it is ridiculous to expect the market to trade up to 25.50 and for volatility to be down at 8% or 7.5%, having trended down as price has gone up, because that would make puts far too cheap, and the market is not going to sell you cheap puts at the top. It is just a ridiculous thought, and that is why the price of volatility in the Nasdaq has been rising rather than falling with the market. We will not see, and it is our contention that we will not see a top in the S&Ps until volatility rises with price. And that this one is the same price chart as before, but with volatility in the S&Ps. As you can see, it has been coming down and testing the same. This is the level that the market was at in March when the volatility in the Nasdaq bottomed. We are now very much at the same price as we were. We want to see this starting to rise towards the 12 to 14 area as the price of the S&Ps rises into the 2500s. That is the only thing that will give us encouragement to think that this is the last leg of the move up in S&Ps. And finally, the price of transports. This is the transport sector, the Dow Jones Transport Index, which has been making new lows on the since breaking the top about 3 weeks ago. It is now coming up to the 200-day moving average. Chances are that we will see now a bounce back towards the high, and that if it doesn't break the high while the S&Ps make new highs into the 2500s with volatility rising proviso, would be the final piece of the puzzle. We would have a large divergence between the transports and the industrials index in the Dow, and that would be the signal that we are very close to a top and it's time to load up with puts. But until that happens, all this is a retest of a 200-day moving average, which is more likely to resolve higher than lower. In conclusion, a word about the model we have created and is running automated in the background about the risk on, risk off position in the market. It is a model which is based on spreads, and it is based on volatility, and is based on liquidity moving from one asset class to the other. It is impossible to have a sustained move lower in equities without money leaving the equity sector and going into the commodity sector or going into the fixed income sector. It has just never happened before, and it is not going to be different this time. This model tracks those spreads and tracks the movement of money into the other sectors. As you can see, the pink area is where the model gets into the market and stays in equities, while the white area is where the model leaves equities and goes into fixed income. The model has been very good about predicting volatility ahead in the markets. It is not 100% reliable, because no model is 100% reliable, but it is very good at giving signals of large amounts of volatility ahead. As you can see, it basically stayed out of the market for the best part of 2 years, while the market did absolutely nothing and just collected money from fixed income. So it actually, in this area here, it actually performed better than the S&Ps, which is pretty good in itself. It is very much in a risk-on phase. But what is happening is that the 50 and 200-day moving averages of the risk are getting very close together. And what this indicates is that any marginal movement towards risk off is going to set off a sell signal, which then amplifies. It is more or less the same situation that we had in 2007, where the market deteriorated in its internals, but the bear market didn't happen until mid to late 2008. The real meat of the move, I mean. It started in January 2008, slowly going down, but the meat of the move didn't happen until mid to late 2008. The same thing could be happening here. This market could have another 5 to 10% on the upside without any problem at all, and then when these moving averages are only ticks away from each other, something pulls the rug and everybody flees equities. The reason why we created this now is because we think that we are close to that point. We don't know where that point will come, but we think we are close to it in time, if not in price. We are big advocates of seeing volatility higher before the market tops, and this model will track it, and this model will give you the sell signal when volatility starts rising with price. So we are quite content to remain long of equities, and also probably to add to our longs, while this tracks and tells us when the time to get out arrives. Thank you very much indeed, and speak to you on Monday.